All right, welcome back to another edition of Financial Accounting. We are going to jump into chapter 6 here in a second, but I want to go look at the schedule really quickly here. We're going to start talking about chapter 6 today, so hopefully you've done your reading ahead of time. If you haven't, please remember that is going to be the number one thing you want to do to keep yourself ahead and able to focus during class time because we go pretty quickly through this course. So make sure you're doing the reading before you come to class. If you have any questions about that, the class, your performance, your exams, please come and see me during my office hours, Tuesday, Thursday, or you can set up an appointment with me. Just email me the days and times that work well for you. We have our third exam coming up here in about a week and a half, so we get a lot to cover here. Make sure that you are staying ahead or just keeping yourself in the game as much as possible. So, chapter 6, we're going to talk about inventory. And this is a bit of a complex chapter, only from the standpoint that it kind of helps to be a visual person in order to understand what's going on here. The flow of goods, how do we account for those things? Inventory is also known as merchandise. It's the goods that we sell to our customer. Sometimes we're the manufacturer, sometimes we are just the intermediary or the wholesaler that takes the goods from the manufacturer and sends them out to the retailer. So we're going to talk about a couple different concepts related to inventory today. Cost of inventory. What is inventory? Realize that when we get inventory, it shows up as a current asset on our books, on our balance sheet. When we sell it, that inventory goes down and we record cost of goods sold. So cost of goods sold represents the vapor trail of all of our previously held inventory. It's important that we make sure that we're clear about the notion of price versus cost. If we are the seller, we have a cost on our books for what we purchased the inventory for. And generally speaking, sometimes when we calculate how the balances change in our inventory, we look at what inventory we had at the beginning, we look at any new purchases we've made during the period, we subtract off those amounts that we've sold, and then that determines our ending balance. You'll see later on, we can rearrange this equation to figure out what we sold by simply saying our beginning balance plus our purchases minus our ending inventory count is going to determine our cost of goods sold. We'll talk a little bit more about the periodic system as we go along, but realize that this is the flow of how we manage our inventory. We start with some balance, we make some purchases, we make some sales, and then we have some left over. So again, it helps sort of be a visual person when you're approaching these topics. Realize ending balance could have multiple units with different cost bases. We're going to have go through some examples where we talk about homogeneous products, where generally speaking, they all have the same cost per unit. But realize that there are going to be problems where the goods that we sell have a different cost basis. So we can have an inventory of phones, but they can have different costs to us depending on when we bought them. So just realize it's going to take time to make calculations in this chapter. And so you want to get really good at quickly drawing things out and making those calculations. What is cost versus price? When we think about inventory and cost of goods sold, we're thinking about the cost it took, how much we paid to get the merchandise. So if we bought the 30,000 units and we purchased them at $60 from the manufacturer, our inventory is $1.8 million. When we sell those 30,000 units, our cost of goods sold will be $1.8 million. That's all based on cost from the manufacturer to us. Those are units per purchase. That's based on the cost. When we sell the goods, realize that we may charge a price that's higher. So recall from the previous chapter that we were selling to our customer at $100 per unit. That's where we got that $3 million figure from. So there's a difference between cost and price, and the difference is what's called gross profit. So the price we charge our customers minus the cost we paid is, in this case, $40 per phone. That's also called gross profit. And we'll talk about that topic later on too. So just going to keep that in mind. We want to charge a higher price over our cost because we have other expenses that we need to take care of. Realize that that upcoming exam is going to require a lot of calculations. This upcoming exam is tough, but I think a lot of you realize that it comes down to doing a lot of practice and be patient with yourself. Don't beat yourself up if things aren't coming quickly. This is a tough class. The balances, the beginning inventory balances, the ending inventory balances, and everything in between. We need to talk about these. Beginning inventory, usually if you've ever worked at a warehouse or you know people who work at a place where there are physical goods, such as bales of hay, for instance, realize that inventory is usually on the beginning basis based on a physical count. So typically what we do in the end of last year is we perform a physical count of our inventory to determine how much we have. The physical count includes all inventory owned, regardless of whether or not it's physically located, whether or not you can see it. We'll talk about consigned goods and goods in transit later on, but realize that the physical count is really, really crucial, that a lot of companies spend a lot of time and money managing their physical counts. Purchases. When we make purchases, typically we fill out a purchase order. It results in an invoice. We get the goods received. Our warehouse manager fills out a receiving report. We send payment for the goods that we receive. There's a lot of in our accounting records that indicates keeps track of all of our purchases. So paperwork really helps us manage that. Cost of goods sold, depending on our accounting system, can be tracked on an ongoing basis using a perpetual system. But we can also we also need to do a physical count at the end of the year, and that can also help us determine or check our cost of goods sold calculation. Regardless, at the end of the year, we're always performing a physical inventory account. Our physical inventory account includes everything owned, regardless of location, but it also, more importantly, determines next period's beginning inventory balance. So counting inventory is a really crucial aspect of companies that sell goods to other customers. Inventory owned, what does it include? So when we talk about the beginning and ending inventory that we own, what does it include? There are goods on site, those goods that we can physically see and count. Those are definitely included in inventory. But we also want to include inventory goods that are on consignment or goods consigned. It's a fancy word for basically saying we have inventory that we own. We own the units, but it's somebody else, like a retailer, that puts it on display for sale to customers. So companies like J.C. Penney, for instance, they'll have a lot of T-shirts and jeans and other items that they have on display, but JCPenney doesn't own that inventory. They just hold it on consignment because they don't want to necessarily be stuck with goods that don't sell. So it's a way to help get our goods sold to the end customer. We use a retailer, we put it on consignment. So we own the goods, but it's physically on display at another company. We want to include those as inventory because we still own the title. When the retailer sells it, that's when we record the cost of goods sold. It's also possible that a manufacturer gives us inventory. We display it for sale to customers. We do not own that inventory. So if we're holding goods on consignment, that's not inventory. That's manufacturer's own title of that inventory. Those goods are on consignment at our place in that case. Goods in transit. So this kind of harkens back to some of these other terms we saw before. When goods are in transit, we have to worry about whether or not the title has transferred to us. So the shipping terms really determine whether or not we own the goods in transit. So for units that we've purchased that are in transit to us, manufacturers sold us the goods. Goods that are shipped FOB shipping point, we own the title to those, and we want to include those as inventory because we got the title as soon as the goods were shipped. FOB destination point means that we only accept title when the goods are actually received at our destination, at our receiving dock. In those cases, those are not owned by us, so they're not considered inventory until they're received. When we sell units to the customer and we sell them FOB shipping point, we do not own those goods. Once they're in transit to the customer owns title to those at the point where we ship them. But if we ship goods FOB destination point, then we still own the goods while they're in transit, and we want to include those as inventory. So when you go through these problems, sometimes they'll tell you that we have these many units on site, we have these many units that are consigned, and we have this much in transit. So you really have to be careful when you read the problems to determine whether or not we actually own title to those goods. If we own title, we want to include those as our inventory. Inventory purchased. Now, what assuming that we actually own the title of the goods, what are all the different costs that determine our overall the overall cost, the net cost to us? So typically we just talk about purchase price. So when we said, hey, I bought it at $60 per unit, that's how much the manufacturer charged me when I bought the thing. But there's other costs incurred just to get the merchandise to my facility. There's things like freight in, cost of transport to us from the supplier or the manufacturer. Maybe I have to pay insurance. I better pay insurance for the transit goods. Taxes and fees are pretty typical, especially if we're importing from, say, China. There's tariffs and other fees we have to worry about paying. But we also want to subtract out any purchase returns and allowances. So this is kind of similar to what we saw in chapter 5, only in this case, we're not the seller, we're the buyer. And if we get goods that are damaged or malfunction, we need to return those. In this, which case those need to be subtracted. And if we have things like 210, if we're offered things like 210, excuse me, I can't write, 210 net 30. If our terms offer 210 net 30, we might get a discount if we pay early, in which case we want to deduct that from the overall cost. So net purchases, that's the cost that ultimately we are paying for a certain number of goods. And we'll go through an example of that in a second. Note that insurance is often included as part of the freight in cost. Usually you're quoted that when you do your freight, they'll say, do you want to insure the cost, the shipment, the goods that are being shipped? Sometimes it's included in freight in. So some people ask me, hey, these problems don't include insurance. Well, then just assume it's part of the freight in cost that we're paying. If it's not, you don't see it, then you just want to make sure that it's added to net purchases, freight in and insurance, otherwise just freight in. If units purchased are homogeneous, meaning if all the units are the same thing, so if we're talking about phones, they're all the same model and brand, okay, then we can determine the cost per unit by taking the total net purchases amount divided by the total units that we purchased. That gives us the cost per unit, and that's what determines our cost of goods sold when we sell it. So to kind of give you an example of how this all plays out, assume that we purchased 570 units from our supplier. The costs are as follows. So we have a purchase price of the 570 units at $841-ish in this case. So total amount, just the cost of the units, it's a lot of money there, is $479. So imagine this is like the iPhone 21 or something like that, right? These are really expensive phones. There's the freight in of 14,000. We paid some insurance of 47 because, hey, these things are fragile and very expensive to replace. Taxes and fees, taxes suck, but that's the way life is. So for 570 units, we paid $579,000. When we get the goods and when the title transfers to us for those goods, we're going to go ahead and record a debit to the balance sheet, debit to the asset account for inventory, 579, and just assume that we're using accounts payable to record all of the amounts that we owe to the shippers and the other taxing authorities, etc. So all the money will be paid later on, but for right now, we'll just throw it into accounts payable. Usually, accounts payable is primarily used to handle these types of regular purchases that we make on a regular basis from our manufacturer. There's the postings. Assets go up, assets equals liabilities plus equity, right? So we see the assets go up and we see that liabilities are going up. And eventually we'll pay it, but usually we want to make sure that we want to check the units to make sure they're actually working. So assume that within the first 2 days that we have the units, we had our receiving warehouse manager go through and check to make sure that they're all working. He found that 10 of the units have to be returned back to the supplier because they're defective. So we're going to go ahead and subtract out 10 units, and the cost per unit again was 840.99. So we'll send those back. The manufacturer will issue a credit memo to us indicating that we will not have to pay $8,410 for those bad units. So we got 560 units, and that's pretty darn good, and we'll stick with that for right now. So there's the overall cost so far. I'm just going to be keeping a running total as I go. When I adjust for purchase returns, I'm actually decreasing the inventory account. I'm also decreasing the accounts payable. The accounts payable specifically to the manufacturer. So I'll have an accounts payable in the accounts payable subsidiary ledger. There'll be an account payable directly to the supplier, the manufacturer. So there's the postings right there. Now we want to go through and say, hey, if these are all good, let's go ahead and pay them right away. Let's do an electronic funds transfer. Maybe we can just directly deposit into their company's checking account. So on February 7th, within the first 10 days, we take advantage of the 2% purchase discount by paying them. So we paid off the balance that we owed them. That's cool, but in this case, we're going to go ahead and take off take a haircut of 2% off the overall amount. So granted, what you see is like there is some amount that the manufacturer is expecting from us, but we're going to subtract off roughly $11,000 from what we owe them in this case. Some people say, well, should you just subtract off based on the cost? And I say, don't worry about that right now. Let's just go ahead and subtract off based on roughly the 2% overall cost. Most manufacturers will say that, look, there's an amount, sometimes the manufacturer will be the shipper, and sometimes the manufacturer handles all the fees and expenses. So this brings up a point that someone had talked about in previous semesters, like, how are all these things arranged? Usually, excuse me, the manufacturer is the one that will keep the 479. The manufacturer can also take money for the freight in, the insurance, and the estimated taxes and fees. Because if a manufacturer needs us to sell their goods, oftentimes they'll be the one to arrange all of these costs into one invoice. Then the manufacturer will collect those items and remit them to the shipping companies and to the taxing authorities. So imagine that this full bulk amount here is really just something that we see on an invoice from the manufacturer. That's a good thing, because otherwise keeping track of these things, who we owe to whom, is just a pain in the neck. So sometimes a supplier can work with us and say, we'll send you an estimate for all the fees and taxes, and then we'll just send you the invoice. So they're knocking off the $8,000 for return goods, and we're going to say we're going to pay early, so we're going to knock off another 2% in this case. So we'll just kind of keep it simple and say, overall, we got 560 phones, and the total net cost to us is $560,000. When we paid the amount to the manufacturer, cash is going down. There's the 560,000. The accounts payable, we are paying that off, so that's going away. 571, and then there's the credit to inventory, which represents the discount that we're taking advantage of right there. So there's all the ledger postings, there's the cost, there's the overall change in the inventory balance leading to the 560,000, and the accounts payable is being paid off. So we got the goods, we made good on our payment. Let's take a look at the summary of overall of what's going on here. So we have the purchase price, free in insurance, taxes, fees, purchase returns, discounts, and what we see is we have total goods of 560. Net amount that we paid was 560,000. So now that we have these goods and we're all cleared with everybody that we owe money to, assume that all the goods, all the phones that we got were homogeneous. We can go ahead and just take the 560,000 and divide it by 560 units to determine the cost per unit. Now, the cost per unit, this is pretty key because that's going to help us from a marketing standpoint determine how much we want to charge to our customers for these phones. Generally, the price will have to be higher than $1,000 per unit, because realize we've got things like depreciation expense, we got salaries expenses, you got utilities expenses, right? So we may have to jack up this price pretty high. So nevertheless, ending inventory at this point in time are based on the units held times the 1,000. When we sell the units, it's going to be based on the $1,000 per unit. Now, when we sell the units, we have to ask ourselves, which type of inventory system are we going to use to update our inventory as the goods are being sold to customers? So an inventory system comes down to two things, the perpetual versus the periodic. Perpetual means that essentially we're constantly updating our records for all goods bought, sold, and available. So every time we make a sale, we are going to record two journal entries. One that's going to be based off of the price, that's the revenue, and that's going to go to accounts receivable or cash. The other journal entry is going to be based on the cost, in this case, the $1,000 per unit. That's going to reduce the inventory and increase the expense account called cost of goods sold. Someone asked me, by the way, why is cost of goods sold not called inventory expense? It's just, it's not worth really knowing for the sake of the exam. Just realize that inventory expense is not the account. We want to use cost of goods sold specifically because that is an industry standard when we use that term. Cost of goods sold is the cost of inventory. We don't use the word inventory expense, but if it helps you to think about cost of goods sold as inventory expense, go for it. Just make sure you don't use inventory expense on any exams in this class. The periodic system only records one journal entry, only records the revenue, which is based on the price. We can determine the the cost of goods sold at the end of the period by doing some simple calculations. Basically, what we'll do is we'll look at beginning inventory plus purchases minus ending inventory. And when we do that calculation, that cost of goods sold right there, that will be what we usually record at the end of the period. So we don't keep it, in some things we don't keep a running total for, and usually it's the things like they're inexpensive goods like powders and liquids and gases. Those things are very hard to track on a per unit basis, even if you are able to track those things accurately. So usually those kind of things are just figured out as a plug figure. So in the inventory, granted, the perpetual system is a little bit more of a pain in the ass because we have two journal entries that we have to record, one for the price and one for the cost. So if we sell 540 of the 560 units that we have, assuming the price is roughly $1,600, what would be the journal entry number one? It would be for the revenue at $1,600 per unit. This is what we're selling now. So $900,000 is what we would expect to receive from our customers. That's the revenue that we record. The cost of goods sold is going to be based on our cost per unit, which is $1,000 times the 540 or 540,000. So inventory is going down, cost of goods sold is going up, accounts receivable is going up, sales revenue is going up. So right off the bat, you can sort of see like what our gross profit is in this case. Our revenue is 900,000. Our cost of goods sold is 540. So when you subtract those, you see that we have a gross profit of 360,000. That seems like a lot of money, but realize from there, now you have to worry about all the S, G, and A expenses, specifically which stands for selling, general, and administrative. So we're talking about salaries, right? You got depreciation, you got utilities, et cetera, et cetera. You got all these other expenses that you need to deduct from gross profit. So maybe it's reasonable that we charge a really high price for these goods. It just sort of depends on the other expenses that we have to take care of. So gross profit is just a starting point. It's just one line item that we have to worry about in this class. Learning objective 6.2 talks about the different cost methods. So there's a difference between an inventory system and a inventory cost method. Recall the inventory system helps us determine when we adjust inventory and cost of goods sold. So in the case of the perpetual system, we're updating inventory and cost of goods sold on a regular basis whenever we make a sale. Okay, the periodic system, we only update inventory and cost of goods sold at the end of the period. The cost method is different. The cost method is saying, given that whenever we do make an adjustment to inventory for sales, how much we record as cost of goods sold depends on the different methodology that we use to track those costs that have been sold. So we're talking about how much to record as cost of goods sold. It's going to be based off of 4 different methods. Okay, you're going to have specific identification, LIFO, FIFO, average cost. These methods determine how much we record when we actually do update for sales. It matters which one we use, you'll see here in a second, because specifically in periods where we have inflation or deflation in prices in terms of the cost per unit, that's going to determine our overall profits. It's going to affect overall income taxes paid. It's going to affect certain ratios like inventory turnover and gross margin ratios. So we'll go through an example towards the end of this learning objective to see how using different methods of costing out our inventory will affect these overall balances. The specific identification method. So in this case, this one is used for very heterogeneous goods. So goods that are very, very unique. So things like antique cars or antique furniture or real estate, things that are very unique, like a specialized car that you see on some of those auctions, right? Those are heterogeneous, okay? If we're talking about like cereal, or we're talking about coffee beans, those are very homogeneous things. So the cost of goods sold in the specific identification is going to be based on the specific cost that's attached to the particular unit. So imagine that a car will have its own price, its own cost tag to it. That's what we're talking about for specific identification. So selling a classic car has its own unique cost. It's not useful for goods with common characteristics. So we don't want to do this for homogeneous goods. We don't want to do it for heterogeneous goods. So for those homogeneous goods, we'll talk about these other methods, how we can use those. So for example, if we sold a $20,000 car for 35,000, what that means is the cost basis is 20,000, and we sell it for 35,000. That's based on the price. So in this case, we would go ahead and use the perpetual inventory system because we know automatically what the inventory costs us. That was part of our overall what we saw in the showroom. That specific identification is not too challenging. Let's see here. But what really comes, you see a lot of companies using are the other different methods, and that's because they have homogeneous goods, goods that are all the same, relatively the same characteristics, right? So we talked about powders, we talked about like big bags of cereal, things like that. They're all basically the same thing. We can just weigh them, right? By the ounce or by the fluid ounce, whatever we want to do. So how do we go about tracking those things? First and foremost, I say create a visual. I mean, it doesn't really matter what we're talking about, if it is gas or solid or liquid. Usually I just sort of say, talk about widgets and talk about units. Units can be based off of just a specific widget itself. So if we had a widget and there's 10 widgets, that's 10 units. Start developing that as a visual. We're going to start stacking from the bottom to the top just to kind of create this visual. So assume that we have a beginning balance of 10 units, and those units have at a cost basis each, a cost per unit of $10 each. So that beginning balance is $100 in this case. Now, go to the next stage here. Assume that we purchased 25 more units, and at the time we bought those, it cost us $14 each. Those are our purchases. Those are the newer widgets. So that's going to be debited to the inventory account, 350,000. And assume in this case, we're going to assume that there was no returns and allowances in this case. If we purchase even more widgets, let's assume that now that's like $18 per unit. This is pretty high inflation, of course, but it's just used for illustrative purposes. We buy another 25 units. This time it's $18 per unit. We're plugging in 450 into the inventory count in that case. So create a visual. Stacking is what I like to do. Stack them. Stacking usually kind of helps you sort of create this visual, because now what we need to do is take a step back and say, given that we have this visual, now we have to ask ourselves, how do we go about selling these units? So down below, we know that we have total units available for sale of 60 units. That was the 10, the 25, and the 25. So imagine we've got this big old bucket here full of 60 units. Granted, the oldest stuff is at the bottom, the newest is at the top, right? Keep that visual in mind as we go through the next steps here. Total cost is, that's in that bucket or in that bin, is $900. So 60 units, 900 in there. The easiest way to deal with this is to use the average cost method, but we'll deal with that last here. What I want to do is talk about the more complicated ways of costing the inventory sold. We need to ask ourselves which goods are pulled from the inventory when they are sold. So when we pull the inventory, are we pulling from the top? Are we pulling from the bottom? Are we just diving our hands into the bin, just grabbing a handful, right? It matters because, again, you've got the old stuff, the new stuff on the top, old stuff on the bottom. So depending on where you grab from this big bucket will determine what the overall cost per unit is. Remember, the old stuff was at what? $10 each, right? So if I pull from the bottom, that's going to have a different cost per unit than when I pull from the top, which was $18 each, right? So that's why we have these different methods of determining how to cost these units out. So let's say we sell 40 units. What is the cost going to be of those units? If we sold all the units, we would just go ahead and credit 900,000, but we're only pulling 40 and leaving some behind. So in this case, should we pull from the oldest or should we pull from the newest? This is generally determined based on the type of physical plant system that you have. So companies generally try to pull from the oldest. They usually try to get rid of the oldest stuff first, like in a grocery store, right? Grocery stores seem to pull all the old products to the front. So when the customers go in, they grab what they see up front and all the newest stuff is stacked behind because you want to get rid of the oldest stuff. The newest stuff tends to be stacked up on top. You don't really see that um, too often in too many companies. I usually sort of think about grandma's candy dish when I'm thinking about um, pulling stuff from the top. That's grandma's the newest candy that she refilled is in the candy dish. The stuff that's nasty is at the bottom, right? So how should we pull from this system? It just depends on how companies set up their warehouse and how they set up the bin to be pulled. So if we do um, have a specific method by which we pull the goods, that's going to determine the cost method for the inventory that we sell. So in the case of if we pull from the top the newest goods, we're going to use what's called a LIFO method. A last in, first out. The last stuff that we bought, the most recent, is the first stuff that we sell. If we're pulling from the bottom, it means the first stuff that went in is the first stuff that goes out. This is the preference for most companies: get rid of the old stuff because they don't want a lot of old stuff hanging around. Okay, so LIFO and FIFO, how does that look? Under the LIFO method, if we're selling 40 units, we're going to basically be pulling 40 of the newest units. They're the last in, so they're going to be the first ones out. So we start by pulling first 25 units because we need to get up to 40. So we'll pull this first. 25 units get pulled first. Then we pull another 15 second. This will be pulled because imagine we're just kind of pulling from the top. So pull, 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 getting it down there. We pull 40 units. We can determine that the first 25 is, because it was at $18 per unit, is costing $450. The next 15 units were the next level down. Those are at $14 per unit. So those were $210. The overall cost, when you add that up, that's $660. That's how we determine ultimately cost of goods sold. LIFO says you're going to be basing the cost on the newest, the most recent purchases that have gone into the bin. FIFO is different though. In the case of FIFO, we're pulling the oldest stuff. So we need to pull 40 units. We're going to start first by digging into the oldest bin. So we'll pull the 10 units at $10 each. So there's 10 units. Then we need to pull in second another 25 units. So we're going to pull those suckers. And then that sums up to what? 35. We need to pull another five units from the next layer. So that's what goes third. So what you see here is the oldest stuff is being consumed right away, and only part of the newest stuff is being consumed. Each one of those has its own cost per unit. A lot of calculations in this chapter, so make sure you become very quick at running these calculations. Draw the visual out, multiply across, determine the overall cost, and then boom. In this case, because it's the oldest stuff was cheaper, the cost is actually $540 per unit. So it's a bit of a difference. When you think about with LIFO, that was the newest stuff, it was more expensive, $660. When it came to the oldest stuff, it was a little bit cheaper, it was $540 because of inflation. Prices change, that affects the overall cost basis. Now, it may just be easier just to kind of mix everything together. So shake it up like a raffle ticket bin or something like that. Just shake them all up. Shake them, shake that bin up. And it won't really matter which one you pull because we're basically saying, all this stuff is basically randomized. We're just going to say we're not going to worry about any of this stuff. We're just going to basically say, look, inside the bin, there are 60 units and the total cost is $900. So if you take the $900 and you divide it by 60 units, you get $15 per unit. That's the easier way of doing it. And you can kind of see here that 18, 14, and 10, these are the different levels here, right? So 15 kind of comes in right about there, right? Is that a fair way of judging the cost on an average basis? Yeah. Is it that if we do actually pull the newest units, are we kind of undercosting? If we're actually pulling the oldest units, are we overcosting? At the end of the day, it may not be material, the difference between what the actual costs are for those units versus the average cost. A lot of companies tend to use this if there's not much variation. So average cost is typically used when you only have like maybe fractions of a penny per unit difference. So if we use the average cost, we're just pulling 60. We have 60 units and they're all considered $15 each. We don't worry about a price tag attached to each one of them. So we pull 40, we just say times it by 15, 600. So it's somewhere in between. It's somewhere in between FIFO and LIFO. Let's compare them all. FIFO, LIFO, average cost. The method with the highest cost of goods sold yields the lowest gross profit. So you might think, well, I want to use LIFO, FIFO, average cost if it results in a higher profit. But generally, you don't do that in, in accounting. You choose FIFO, LIFO, or average cost based on how the physical plant is actually set up. So if we are using LIFO, recall that the cost of goods sold was 660, but under FIFO it was 540, and average cost it was 600. Average cost is usually somewhere in the middle between LIFO and FIFO. If you subtract off 660 from $1,000, you get a gross profit of $340. Again, we're assuming that the sales revenue in this example is $1,000. FIFO has a small cost of goods sold, therefore really big gross profit. Average cost is somewhere in the middle. Average cost is kind of even Steven. Now, gross profit margin, which a lot of investors and analysts tend to calculate, looks at the 340, for instance, takes 340 and divides it by the overall revenue. That's how you determine gross profit margin. Gross margin is often a way to sort of benchmark different industries to see whether or not, see which industries are charging the most. So if you look at, say, Ford, Ford versus Ferrari, okay, Ford's going to have a very low gross margin, right? But a Ferrari is going to have a very high gross margin. And that's simply because of the quality of the car, right? Ferraris tend to be very, very expensive. They're not produced very much. Ford's kind of based on a very churn and burn kind of a mentality. So high gross margin, usually because of a high price. Even if you do have a high cost of goods sold per unit, Ferrari charges a huge premium. Charges huge premium. Premium is essentially looking at sort of like at a price level, an average price level, and charging a bit above that. So FIFO in this case, when we sort of compare all these guys, notice how that FIFO produces the highest gross profit. And the reason why is because it has low cost of goods sold. Low cost of goods sold, low cost of goods sold, high gross profit. High cost of goods sold, low gross profit. So they kind of work against each other. And that's only because in this case, the prices are increasing. So even though the dynamic seems kind of confusing, you kind of have to sketch it out and just do the quick math and see how this works. High, low, low, high, right? But realize that the only reason it works in this particular case is because prices or costs per unit are increasing over time. Recall that we had a beginning balance of 10, then the cost went up to 14 and then 18. The costs were increasing over time. That's what determined the overall amount that we see reported as cost of goods sold. But if you reversed these, if you reverse the order of these, say that you had beginning cost was 18 and the cost went down to 14, then down to 10. If unit costs decrease over time, we would see that LIFO producing the highest gross profit because it shows the lowest cost of goods sold. It's just a mechanical, mathematical sort of phenomenon that you need to be aware of, because there's always at least one question that talks about on an exam about, hey, what happens if costs are decreasing over time versus increasing over time? Which method is going to produce the highest cost of goods sold? So watch out. These are good exam questions. Now let's take a look at the ending inventory. Usually the method that has the highest cost of goods sold is going to end up with the lowest ending inventory. And that's simply because the units leaving are the most expensive. The stuff that's left behind is the least expensive. In the case of LIFO, remember that our cost of goods sold was really, really high. That's because that was the newest stuff. In this case, the newest stuff had the highest cost, right? This was high, so therefore you get a low in the inventory balance. FIFO, you have a low cost of goods sold, therefore you have a high ending inventory, and that's the newest stuff is left behind. Newest stuff is left behind under FIFO. Average cost is somewhere in the middle. So FIFO produces the highest ending inventory balance, but again, that's only because costs are increasing over time. If we flip the order of these, right, if we saw that costs were decreasing over time, we would actually see that LIFO produces the highest ending inventory balance. Just go through. This is why the homework is so crucial. When you go through, make sure you understand what the phenomenons are that are going on. A lot of questions on 6.1 and 6.2 ask you to interpret these phenomenons that you're actually calculating. So, kind of summarize it all together. So what? Who cares? All this information. Let's take a look at LIFO. So what? Who cares? Consequences of using LIFO. LIFO results in a higher cost of goods sold in this case because prices are increasing over time. If you have a higher cost of goods sold, you're going to have lower net income and therefore lower taxes. So less profit, but hey, you're paying less in taxes. So, there's no real like win-win situation here. It's, something given, something gained. Cost of goods sold, net income tend to be more realistic because it's based on the current costs. So a lot of people like using LIFO because it's based on the current cost. What you see on the cost of goods sold represents what it cost us from a recent purchase standpoint. Ending inventory tends to be has a lower value in this case because again costs were increasing over time. Lower cost per unit means that the inventory we see on the balance sheet is relatively old, outdated. It's old stuff, it's outdated, so it's not a realistic cost on the inventory side. So basically the income statement, we see costs that are more realistic, but on the balance sheet, what's left behind is not a realistic cost per unit. So there's good and bad with LIFO. And the same thing can be said about FIFO though. FIFO, remember in this example, resulted in a lower cost of goods sold. So you get high net income, therefore higher taxes. The cost of goods sold we see on the income statement is less realistic because it's old. It's based on the old cost per unit. Granted, we want to get rid of the older stuff, but when we look at cost of goods sold, we have to ask ourselves, is that really what it costs to buy those units today? On the balance sheet, we see that we have a higher cost per unit, and that's because the stuff that's left behind in inventory is the newer stuff. So on the balance sheet, we have a more realistic cost per unit that we see because the older stuff that's left behind represents the cost of that newer stuff. Some other things you just need to know, at least for the sake of the exam and for the homework here, is we know that cost methods affect profits and ending inventory balances. You just need to be aware of that going into the homework and the exam. Consequences of LIFO, in our case, typically what you see are higher cost of goods sold because prices are increasing over time. Net income tends to be lower, therefore it's less real. We don't really see very realistic performance figures on the income statement aren't very realistic. There's also a situation where you can potentially, because the costs we see are the current costs, is the most current costs, that it allows for things called earnings manipulation. We can manipulate earnings by timing when we buy inventory. So if we want a really high net income, we can buy when the costs go down temporarily. If we want to somehow subdue net income, we can buy when prices or the costs are really high. So that's just a phenomenon that some companies have been known to take advantage of, but it's very difficult to prove that. There's a thing called LIFO liquidation. And I won't have you do it necessarily in this class, but essentially it's a way of addressing the issues up above. It's like regular LIFO, but it shifts some of the older costs into cost of goods sold. Just know that from a conceptual standpoint. Incorporates some aspects of FIFO. Ending inventory balances tend to be the older, the cheaper stuff. Again, this is under LIFO. That's the old stuff. So if any inventory is oldest, it's the unsold units. Maybe those are bad units. Maybe those are unwanted units. Those may become obsolete, unsellable. Maybe there has to be a write-off of inventory. We talked about a write-off of accounts receivable. We can also have a write-off of inventory that becomes obsolete. So those are all the notes I have for 6.1 and 6.2. Make sure you jump in on the homework and stay on top of things because we got an exam coming up here pretty quickly. But in the meantime, if you have any questions, please let me know.